Okay, so why I love this task-based simulation is because it's challenging your ability to think critically and really see the full picture when it comes to what they love to ask related to bonds. Okay, so when it comes to bonds, your success is going to live and die with understanding the effective interest method. So as you remember from our lecture, the effective interest method is the circle of life, just like the Lion King. And the point of the effective interest method is to amortize bond premiums and bond discounts. We remember that there are two items that are being presented in the balance sheet. We have the bond's liability itself, but we also have the discount and the premium. And that's the difference between the issuance price and the bond's face value. This difference is what it is we're ultimately amortizing. Okay, so this amortization is going to impact both the carrying value to the premium and the discount itself, as well as the bond. Okay, so at the end of the day, they can ask you to determine the bond's ending carrying value after the amortization expense has been determined after a specific interest pay period. And as we said, they can also ask you to determine the ending carrying value of the premium or the discount itself. Okay, that makes sense, right? After all, this is what it is we're amortizing. So after the amortization expense for a specific period has been determined, the bond discount or the bond premium will be reduced, just like if we were depreciating a tangible fixed asset. Another super important takeaway from this sim, and another topic that they ultimately love to test your knowledge in, is how the issuance of a bond in between payment dates impacts the initial carrying value of the bond. Okay, aka how accrued interest is going to impact the bond's carrying value and ultimately the rest of the table. Okay, so we're looking at Alliance Corp, and they issued two bonds. So let's go through each of these bonds one by one and determine the related descriptions respectively. Here we go. Bond number 1. This bond was issued on January 1st, year 1. Okay, so it was issued at 6%. It's a 10-year bond and has a face value of $140,000. It was issued at a price of $125,000. Okay, so we know that the bond is paid semi-annually. The payment dates are July 1st and December 31st. Okay, so the market rate of the bond was 8%. So two reasons we know that this is a bond discount. Well, for one, the bond's issuance price is less than the face value, right? Face value $140,000, issuance price $125,000. We can confirm that by seeing that the stated rate is less than the market rate, right? When we think about discounts, we're thinking greater market discounts. Okay, so now we have enough information to build out our table. At the end of the day, this effective interest method table is going to be your sanctuary. You must know the 5 steps in our mental map. Okay, so the first thing we need to be on the lookout for when it comes to bonds is the dates. We must pay attention to the dates. We know that this date is going to be paid semi-annually. So what we need to do is divide our interest rates by 2. If it was quarterly, we'd be dividing our interest rates by 4, but it's semi-annually. Okay, so we're dividing our rates by 2. Okay, so the stated interest rate becomes 3% and the market interest rate becomes 4%. All right, so we know the beginning carrying value is $125,000. That is getting multiplied by the market rate to determine the semi-annual interest expense. All right, so the July 1st semi-annual interest expense is $5,000, $125,000 times 4%. Okay, so that is the correct answer choice for this first description. All right, so we must go through the rest of the table. So step 1 is complete. We determined the beginning carrying value. We also determined step 2, which is the semi-annual interest expense. Now moving on into step 3, which is determining the semi-annual interest payment. This is the cash that's going out the door. Okay, so they're paying this semi-annually. So again, 3% is now what we're multiplying times the face value. Okay, so the face value is $140,000. That amount times 3% gives us a semi-annual interest payment of $4,200. And we remember that the semi-annual interest payment is going to remain the same for every single pay period. And reason being is because the face value is never going to fluctuate. It's the carrying value that is getting impacted by the semi-annual interest payment and that amortization. Okay, so we can now determine the amortization expense for the July 1st date. We're going to take the $5,000, reduce it by the $4,200, right? Step 2 minus step 3 to give us an amortization expense of $800. We can now add step 1 by step 4 to give us our ending carrying value. Okay, so our ending carrying value as of July 1st is going to be $125,800. Okay, boom. There's our correct answer choice for July 1st. That now becomes our beginning carrying value for the second interest pay period. Okay, so as we said, the carrying value is what's fluctuating. The $125,800 has now fluctuated from $125,000. This amount is now multiplied once again by the semi-annual market rate. So 4% times $125,800 gives us an interest expense of $5,032 for the December 31st date. All right, that's going to the income statement. The interest payment is, as we said, going to remain the same. Still going to be the $140,000 times the semi-annual stated rate of 3%. So $4,200 yet again. Okay, but they're asking for the interest expense. So the December 31st interest expense is going to be $5,032. Our amortization expense for the December 31st date is now $832. So we're adding $832 to the beginning carrying value, step 1 plus step 4. So $125,800 plus $832 gives us an ending carrying value on the bond of $126,632 for the December 31st date. Okay, boom. We have now completed our effective interest method table for the bond's carrying value. They're also asking for the ending carrying value for the unamortized bond discount or bond premium. In this case, this is a discount. And the initial discount is $15,000. How do we know that? Because the bond's face value is $140,000, but the issuance price was $125,000. So $15,000 is the difference. This is the amount that is fluctuating. Okay, so again, same table more or less, only we're changing the carrying value that is getting amortized. Okay, so regardless of what it is we're calculating, this effective interest method table is going to apply the same steps for steps 2, 3, and 4. Okay, so for the July 1st date, the interest expense is still going to be $5,000. 4% times $125,000. The interest payment still going to be $4,200. 3% times $140,000. The amortization expense going to remain the same. $5,000 less $4,200. Okay, so we're going to just say that this is the absolute value that is getting amortized. Okay, so $15,000 is going to be amortized, meaning we're going to be bringing this value down. Another way to think about this is making this a negative figure and adding the step 1 to the step 4 yet again. All right, but just remember conceptually that we're bringing this value down just like we would be depreciating a fixed asset down. Okay, so the $15,000 is going to be reduced by the amortization expense. The ending carrying value for bond 1 is $14,200. Right, we're amortizing that $15,000 discount down by $800. Okay, steps 2, 3, and 4 are going to remain the same. The interest expense for the December 31st date is $5,032. The interest payment still going to be $4,200. And the amortization expense going to be $832. We're now bringing the $14,200 beginning carrying value of the discount down by $832. So the ending carrying value, right, the unamortized portion, the amount that is left to be amortized, is going to be $13,368 on the December 31st date. Okay, done with bond number 1. Now let's take a look at bond number 2. Okay, so bond number 2 is going to be a little bit more challenging because here we see that the bond was issued on March 1st. Interest payments are going to be the same. Semi-annual interest payments on July 1st and December 31st. All right, but we also see that the bond was issued with a 7% stated rate with a face value of $210,000 at a price of $245,000. The bond's market rate is 5%. Two reasons we know that this is issued at a premium. Well, for one, the issuance price of $245,000 is greater than the face value of $210,000. But we can also confirm this because the market rate is less than the stated rate, right? We're thinking greater stated premiums. All right, but what's most tricky about this and why it's different from bond 1, other than the fact that it's a premium instead of a discount, is the fact that we have accrued interest, right? The bond was issued on March 1st, but the interest pay periods are July 1st and December 31st. Okay, so we got to pull out our 4-step approach for determining accrued interest. And we ultimately want to determine its impact to the initial carrying value. Step 1 in our 4-step approach is determining the carrying value before considering accrued interest. Okay, so the beginning carrying value we know is $245,000. Okay, in step 2, we're determining what the first interest payment would be without considering accrued interest, right? So how we would normally determine that semi-annual interest payment. Okay, so we're going to be dividing the rates by 2 again because the interest payment is made semi-annually, meaning the stated interest rate is going to now be 3.5%. 3.5% is getting multiplied by $210,000. That's going to give us a semi-annual interest payment of $7,350. Okay, so step 3 is determining the percentage of the first interest pay period in which the bond was not outstanding. Okay, so again, thinking about a landlord, right? Just as we mentioned in our lecture, you're not going to pay rent for a unit that you are renting for the time that you didn't spend, right? So if you, let's say, rented your apartment on January 15th, you're not going to pay rent at the end of the month for the entire month. They're generally going to prorate that first month for January 15th through the end of the month. So that January 1st through the January 15th date is the amount that you do not owe from the first payment. Think of this as your accrued interest. This is the period in which you didn't own the bond. Okay, so if the bond was issued on March 1st, that first pay period is going to be for the months of March through July 1st. That's 4 months, March, April, May, and June. Okay, so the first 2 months becomes your accrued interest portion. All right, so January and February is going to represent 2/6 of the first pay period. This is the amount that has been accrued. So if $73.50 is the 6-month payment amount, what's the monthly payment amount? Well, $73.50 divided by 6 is going to be $1,225, and we accrued 2 months. Okay, so 1,225 times 2 is going to give us an accrued interest amount of $24.50. So now we're going to add the accrued interest to the beginning carrying value. Okay, so $24.50 plus $245,000. Our initial carrying value is going to be $247,450. This is the amount that we're now multiplying by the semi-annual market rate. So we know the annual market rate is 2.5%. $247,450 times 2.5% gives us a semi-annual interest expense of $6,186 for July 1st. Right, we already determined the semi-annual interest payment. That's $7,350. Okay, so step 4, determining the amortization expense, we're going to subtract step 2 by step 3. So $6,186 less $73.50 is going to give us an amortization expense amount of $1,164. We can now add step 1 to step 4 to calculate our step 5 ending carrying value. $247,450 plus $1,164 gives us an ending carrying value after the July 1st payment date of $246,286. Okay, so we now determine the interest expense and the ending carrying value for bond number 2, and that is for the July 1st date. Okay, so $61.86 and $246,286 would be these two answer choices. $246,286 now becomes our beginning carrying value for the December 31st interest payment date. Okay, so $246,286 multiplied by 2.5% gives us a semi-annual interest expense amount for the December 31st date of $6,157. Semi-annual interest payment is still going to be $73.50. So the amortization is going to be $1,193. $6,157 minus $73.50. Okay, and that's going to give us an ending carrying value of $245,093. All right, we now know our ending carrying value and our semi-annual interest expense for the December 31st date. Okay, so these two would represent the correct answer choices. Okay, so that is how it's done. And at the end of the day, if we know these effective interest method tables, you're going to get these right every single time.